Every year during the holidays, Americans spend a ridiculous amount of money on Christmas presents for their spoiled children. And sometimes they go to great retailers like Target, or sometimes they go to Walmart. But did you know that there's one company that at the end of the day is profiting no matter what retailer you go to, and that is Visa. So today we'll be doing a full stock analysis of Visa. I'll be discussing their business model and all the important financials that you need to know before you invest. And you can even use your Visa cards to buy the Do Dividend Stocks.Drugs merchandise, the link's in the description. We have a 15% off sale right now throughout Christmas, and it's the best gift for any dividend investor that you know in your life. Thank you all, and of course, roll the intro.
Here comes Santa Claus, here comes Santa Claus, right down Santa Claus.
Please, it's too much winning.
Reindeers pulling on.
Hello, I like money.
The investing software that I'll be using in today's video is DividendData.com. Now, if you guys are interested in this and want access to the entire website, use my link. It is in the description. I get like half of the sale, so it greatly helps the channel. I can't even put into words. Visa, stock ticker V, is a payments processing company. A lot of people misconceptionize that Visa is a credit card company. That is false. They make their money from payment processing. Visa has systems and headquarters throughout the entire world that are built and protected from terrorism, cyber attacks, natural disaster, etc. Currently, one share of Visa is trading at $258.37 per share. This has riled up in the last month or two, along with the entire stock market, as investor sentiment is once again high. Currently, Visa has been recognized as one of those stocks that is always going to trade at a premium because of the quality of their business itself. The stock is currently trading near all-time highs. We can see that Visa currently trades at a dividend yield of 0.81%. Now, Visa typically does not trade at a very high dividend yield itself. Their current dividend yield is actually a historical high for them, as they just increased their dividend, which we'll get into later today in the video. They're currently trading at a P ratio of 31, which many investors will say is overpriced, but we'll get into that. So the way that Visa really makes money, again, is its payment processing fees. Essentially, every time that you buy something using the Visa network, essentially every time you make a credit or debit card, Visa will charge a fee to the business that you're basically making the transaction from, and typically you're going to have to pay it. Now, this fee is undeniable, and I think the best thing really with the fee is that they have major pricing power with this fee. During tougher or thinner economic times, Visa can just increase and hike that fee, which we actually saw just a few months ago. This allows Visa's financials to be as flawless as they are. Now, Visa and MasterCard are in a duopoly right now when it comes to the payment processing network. They have two networks basically that businesses can choose from, and it's really not a competition with any other third-party companies, so it's just those two. If you're curious to know what the actual difference is between the two companies, Visa has a larger market already, while MasterCard has a larger return on invested capital. They are ideally the same company, but the reason I chose Visa over MasterCard was the larger market share that they currently have. Alright, to start off looking at Visa's financials, this might give you a wet dream if you're a dividend growth investor, and I'm not even going to lie. To start off, let's go over the revenue. Now, revenue is not really an important metric. It's a much overrated metric. The real metric that you want to look at when you're looking at a company's financial health and how much money they're actually raking in is the free cash flow. Because companies like Tattooed Chef can be bringing in a whole lot of revenue, but they're not profitable and they're not actually making money. The free cash flow is what goes back into the shareholders' hands at the end of the day. And we can see here, this is just a thing of beauty. Their 3-year revenue growth rate is 15.37%. Their 5-year revenue growth rate is 11.29%, and their 10-year revenue growth rate is 13.25%. That's incredible, and it just shows how effective these price hikes are when it comes to their processing fee. Now, the revenue can be good, but we'd ideally like to see it equate in a free cash flow, which in this case it pretty much does. I think it is blasphemous of how good Visa's financials really are, and I'm going to say this at the end of the video. I really think the biggest risk to their business is not a recession, it's the government intervention. Now, the only time that really in the last 10 years that Visa took a notable dip on their free cash flow was during C-19, which is very understandable, but even then they held up just fine. Now, their 3-year growth rate on the free cash flow is 27.75%. That's going to be a little fluffed up, obviously, because of the C-19 decline that they had. Their 5-year free cash flow growth rate is 12.09%, and their 10-year free cash flow growth rate is a ridiculous 25.46%. Now, I don't know if this will be sustainable for the next 30, 40, 50 years, but I know one thing for sure is that this free cash flow growth rate is definitely not slowing down whatsoever. Now, would I expect free cash flow growth of 25% if you're going to be holding this stock for 40 and 50 years? Probably not, But this is a company that's going to be consistently producing a lot of free cash flow at a very quality growth rate if you're an investor. So the most important financial metric of a company, free cash flow, is definitely a green flag for me. Get a towel because it gets even better than this. To start off, their margins are incredible. Their gross margin is currently sitting at 80.31%, and it has averaged there for pretty much the last 20 years. Now, something that I love to see with profitability is just consistency. There are some companies that I do own, and I'll be admitted to this, where profitability is kind of volatile and it averages out over time, and that's kind of the hope, and I just accept that with the valuation target. But for Visa, it's just consistent, and it's always staying there, and I love this so much. It's just a flat line. Their operating margin is 64.47%, which, again, it averages out there, and their net margin is 54.37%. This is absolutely wild, and it just shows how much of a behemoth of a company and how much of an efficient business process that they really do have. This is a business that I want to be invested in. Consistently produces profits, even during tougher economic times, consistently produces free cash flow, and I haven't even gotten to the dividend yet. We also love businesses that don't have half of their free cash flow in debt, and that is the case pretty much for Visa. Visa's debt has been under control, and they've actually had less debt since 2022, just consistently paying it off, and once again, just being a financial titan of a company. Stock-based compensation is something that can actually kill a company's free cash flow and financials when it's really done in large amounts. We can see in this case with Visa, it is not an impact whatsoever, and it is nothing relative to their behemoth free cash flow growth. For my dividend growth focused investors, try to contain yourself here because this is actually amazing. Visa's dividend growth is one of the most infamous things about the company when it comes to the investing community sentiment around it. Their 3-year dividend growth rate is 17.57%. Their 5-year dividend growth rate is 19.88%. And their 10-year dividend growth rate is 17.92%. Keep in mind they're doing this with a ridiculously low payout ratio. They just recently increased their dividend 15.56%. And that's pretty solid for, a time where everybody thinks we're going to go into a recession. And the wild thing about this dividend growth is that it's sustainable beyond belief. Currently, even after their recent 15% dividend hike, their payout ratio based off of free cash flow is only 19.04%, meaning that they have 80% of their remaining free cash flow to reinvest back into their business, or just store it, or just put it back into share buybacks, which we'll get into, trust me. That's absolutely wild. Most companies in my portfolio have a 40, 50, 60, or even 80 at the highest percent payout ratio. This is actually ridiculous with the dividend growth that they've recently had. Their earnings per share payout ratio is only 21% too, so it's not like there's any crazy difference. I prefer free cash flow per share payout ratio. That's more of an accurate judge of how sustainable it actually is, based off of the real profits they're producing. Another amazing way that companies can choose to reward the shareholder for holding their company long term is share buybacks. Essentially, you own more of the company over time if you just hold on to your remaining shares. And that has been something that Visa has been doing since 2014 now, and it has been insane. Visa's recent share buybacks have been amazing, even at the current prices. Now, this would be an indicator that Visa's management and the people who are actually buying back this stock think that they're at fair price or even undervalued relatively to where they're intrinsically believed at. Visa's really amazing when you look at it at the end of the day. It's slowly becoming probably my favorite company in the portfolio right now. It's right up there with Microsoft and Apple. Right now, it's also a core holding in my portfolio too. I was adding a boatload of Visa at the $220 to $230 range, and I was even buying near the 240s. Unfortunately, the stock price has gone up, and I've kind of paused my buying for now. I'd like to see where it averages out for a few months, and I hate buying stocks at 52-week highs, and especially when investor sentiment is high. Ideally, when everybody thinks we're going into a recession and there's a lot of fear, that's when I want to buy Visa. But at the end of the day, I think Visa's fair price, $220 to $245, $250, I think that's a fair price for Visa. I'm definitely not afraid of paying a premium, and I'm going to be holding the stock for a ridiculously long time. My yield on cost on Visa will be incredible in 5 and 10 years, and I can only imagine what it will be like in 40 and 50 years. Of course, there are risks to any business that you invest in, and the future is not predictable whatsoever, but with a company like Visa, it's really hard to find a lot of risks to it. I think the biggest risk for them really would be recession, maybe a new fintech company really emerging is a good solution, but I think Visa and MasterCard are the gatekeepers right now. The government has consistently pursued lawsuits against Visa for being a monopoly. Now, most of the time this really doesn't amount to anything, so I wouldn't be too concerned about this if you are a Visa shareholder, but I really do believe that's the biggest risk to them right now, going out of business. And those are all the reasons that I love Visa so much. I want to thank you for making it to the end of the video. It took a lot of time to make this one, a lot of research and a lot of effort, and I think it's one of the highest quality stock analysis videos I've done so far. So if you appreciate that, make sure to hit that subscribe button, turn on post notifications. If you like Real Man's Investing, Visa is certainly Real Man's Investing. Go check out the merchandise link in the description. Use 15% off. Thank you all for watching, and of course, do dividend stocks, not drugs. Have a good one.